There's a debate that never really ends in investing: individual stocks versus ETFs. Do you pick your own companies and try to beat the market? Or do you just buy the whole market and let it ride? For a long time, I was somewhere in the middle. I owned individual stocks, I owned ETFs, and honestly, I didn't have a clear reason for doing either. But in April, I finally picked a side. I sold about $82,000 worth of individual stocks across my TFSA and my RRSP, and I moved that money into 3 ETFs: XEQT, VFV, and VDY, split roughly equally between the three. It felt a little scary making that decision, but looking back, I think it was one of the better financial decisions I've made. So in this video, I want to walk you through why I made that switch, how I got into individual stocks in the first place, what eventually changed my mind, and why simplicity became more valuable to me than trying to find the next big winner. Just to be clear before we get into it, this isn't financial advice. I'm not a financial advisor. I'm just showing you what I did with my own money and why. I didn't start investing seriously until 25, which honestly feels pretty late to me now. My parents never talked to me about investing growing up, so I didn't grow up understanding how any of this worked. I basically had to figure it out myself. And when I finally started, my strategy was extremely sophisticated. I bought companies I knew: Apple, Tesla, Costco, Nvidia, a few other random companies. That was pretty much it. I wasn't sitting there building some incredibly detailed investment thesis. I just thought, I know these companies. I like these companies. People use their products, so why wouldn't I own them? Then something really dangerous happened. Some of them went up. So obviously I thought I was a genius. When Nvidia went up, I felt like I had figured something out. When Apple went up, same thing. And when one of them dropped, suddenly I was checking my account way more than I probably should have. I'd start wondering, is something wrong with the company? Should I sell? Should I buy more? Is this just temporary? And that's really how I got into individual stock picking. I wanted to build wealth. I wanted to eventually reduce how much I had to work. And ultimately, I wanted my investments to give me more freedom and more time with my family. But at the time, I thought the way to get there was to find the right companies and beat the market. And honestly, I really enjoyed it. I liked researching companies. I liked looking at earnings. I liked trying to understand why a stock moved. I liked finding a company I thought was undervalued and thinking, maybe the market hasn't figured this out yet. That part was genuinely fun. But there's a problem with something being fun when you're using it to manage your life savings. The more I learned, the more complicated my investing became. Instead of just buying a company I liked, I started thinking about valuation, earnings, growth, competitive advantages, management, industry trends, and everything else you can convince yourself you need to know before buying a stock. And the more I learned, the more confident I became that I could make better decisions. That's where things get interesting, because I wasn't necessarily doing anything stupid. I wasn't throwing my money into random meme stocks every week. I was trying to buy good companies and hold them for the long term, but I slowly realized that managing individual stocks takes a ridiculous amount of attention if you actually want to do it well. You've got earnings coming out, you've got guidance, you've got changing valuations, you've got competitors, you've got interest rates, you've got management decisions, you've got entire industries changing underneath you. And I'm not an analyst sitting in an office 8 hours a day doing this. I've got a job, I've got a family, I've got other things I actually want to spend my time doing. So eventually I started asking myself a pretty uncomfortable question. How much of this time am I spending trying to optimize my portfolio? And how much of it is actually improving my results? Because those aren't necessarily the same thing. This is where my thinking really started to change. I had winners. Absolutely, Nvidia was one of them. There were other individual stocks that performed really well for me too. And those wins were fun because they made the whole strategy feel justified. But I had losers too. I had one Nvidia position where I lost somewhere around $4,000 to $6,000. That one stuck with me because I had spent a lot of time thinking I understood what I was buying. I was wrong. And that's the thing about individual stocks. You can be right about a company today and still be wrong about what happens to it 5 years from now. A company can have great products, great management, great financials, and still run into problems you couldn't predict. The industry changes, competition changes, consumer behavior changes, management makes a bad decision. The valuation gets completely detached from reality. So now you're sitting there trying to figure out whether you've got a temporary problem or the beginning of a much bigger one. That's a hard problem, and I realized I didn't necessarily want that problem anymore. The question eventually stopped being, can I pick good stocks? I think I can. The harder question was, do I want to spend the time required to consistently manage a stock portfolio when my actual goal isn't to become a professional investor in the first place? Because my goal isn't to spend my life researching companies. My goal is to build enough wealth that I eventually have more control over my time. I want to reduce my working hours. I want more time with my family. I want my investments working in the background while I'm actually living my life. And that created a bit of a contradiction. I was spending more and more of my time trying to optimize the thing that was supposed to eventually give me more time. That didn't make much sense. So in April, I finally decided to simplify everything. I sold approximately $82,000 worth of individual stocks across my TFSA and my RRSP and moved that money into 3 ETFs, XEQT, VFV, and VDY, roughly 1/3 into each. And the interesting part is that this wasn't because I suddenly decided individual stocks were bad. It was because I realized they weren't necessary for the outcome I wanted. The biggest advantage for me was diversification. With an individual stock, I have to be right about that specific company. With a broad ETF, I don't. If one company screws up, another company can be doing something completely different. If one industry struggles, another can be growing. And if a company I own through the ETF becomes the next massive winner, I still participate in that growth. Without having to predict which company it'll be 10 years beforehand, that's what I really like about it. I don't have to find the next Apple. I already own Apple. I don't have to figure out which company is going to become the next Nvidia. If it matters enough, I'll probably own it through the ETF anyway. And if some company that looks amazing today falls apart 5 years from now, I don't have to be the one who catches it in time and hit sell. The portfolio handles that diversification for me. That's a huge mental advantage because when you own a handful of individual companies and one of them drops 30%, you immediately have a decision to make. Do I hold? Do I sell? Do I buy more? Is this a buying opportunity? Is the company actually in trouble? With a broad ETF, I can look at the market being down and just say, yeah, the market is down. That's it. I don't have to figure out which company is going bankrupt. So what did I actually buy? The $82,000 I moved went into 3 ETFs, XEQT, VFV, and VDY. I split it roughly equally between the 3. I wanted a combination of broad diversification, exposure to the US market, and dividend-focused companies. And this isn't the only money I have invested. My other accounts are actually larger. They're already primarily invested in broad market ETFs. So this wasn't some completely new philosophy I suddenly invented in April. It was more like bringing one part of my portfolio in line with how I was already investing everywhere else. My TFSA is now sitting around $120,000, and I'm continuing to contribute roughly $1,000 to $1,500 a month between my RRSP and my non-registered accounts. And that's actually one of the biggest things I've realized through all of this. The boring part is the part I can actually keep doing. Now, there's an obvious argument against everything I'm saying. What if you can beat the market with individual stocks? And that's a completely fair question, because the funny thing is, I actually have been outperforming the broad market by roughly 1% to 2%. So why would I stop? This is where I had to separate two completely different questions. The first question is, can I outperform the market? Maybe. I've done it. The second question is, Do I want to spend the time, attention, and mental energy required to keep doing it? That's a different question. And for me, the answer became no. Because even if I can outperform the market by a couple percentage points, what am I actually giving up to do it? Time spent researching, time spent watching earnings, time spent thinking about whether a company is overvalued, time spent wondering if I should buy, sell, or hold. And there's always the risk that I get it wrong anyway. Because being up 1 or 2% doesn't automatically mean the strategy is better. If the process requires substantially more of my attention, I'm not trying to win an investing competition. I'm trying to build wealth. Those sound like the same thing, but they're not. And because I'm Canadian, there's another part of this that matters a lot. The TFSA. For me, the TFSA is one of the most valuable investing tools I have because qualified investment growth and withdrawals are generally tax-free. So if I'm going to build long-term wealth, I want to make sure I'm actually using that account properly. And that's one reason I care more about the overall structure of my portfolio now than I did when I first started. When I was 25, I was thinking, which stock is going to go up? Now I'm thinking about the entire system. Where is the money invested? What is the risk? How diversified am I? How much time does this require from me? What happens if the market drops 30%? And most importantly, can I stick with this for the next 10, 20, or 30 years? Because that's the real game. Not finding the perfect stock next Tuesday. I'm 34 now, I've got work, I've got a family, I've got kids, and my life isn't getting less complicated. It's getting more complicated every year, and that changes how I think about money. When I was younger, I had more time and fewer responsibilities. So spending hours researching a company didn't feel like a big deal. Now I look at that same 2 or 3 hours and think, I could be doing something else. I could be working on my business. I could be spending time with my kids. I could be doing something with my wife. I could be creating something. Or I could just be sitting on the couch, playing a video game, which honestly has some value too. And I think that's something people miss when they talk about investing. They talk about returns, they talk about percentages, they talk about beating the S&P 500 by 2%. But your time has value too. If the whole reason you're investing is to eventually buy back your time, it doesn't make much sense to spend your entire life obsessing over your investments. That's the part I finally understood. Now, I'm not saying individual stocks are bad. There are people who are genuinely incredible at analyzing businesses. There are people who can outperform the market consistently. And if that's you, great, keep doing it. But be honest with yourself. Don't ask, did I beat the market this year? Ask, have I beaten the market over 5 years? Then ask, did I beat it after accounting for the additional risk? Then ask the question nobody likes asking. How many hours did I spend doing it? Because one great stock pick can make you feel like a genius. You buy Nvidia before it takes off, and suddenly you're convinced you've cracked the code. But what about the 5 other stocks you bought that didn't? What about the one you held too long? What about the one you sold right before it recovered? What about the next 5 years? That's where it gets difficult. And that's exactly why I decided I don't need to play that game anymore. At the end of the day, my goal isn't to have the most impressive portfolio. It's not to tell somebody at a barbecue that I found the next Nvidia before everybody else. My goal is pretty simple. I want to build enough wealth that I can eventually work less, spend more time with my family, and have more control over what I do with my life. That's it. And if buying broad market ETFs every month gets me there, without requiring me to constantly monitor individual companies, I'm perfectly okay with that being boring. Actually, I think boring is probably exactly what I want, because the less I have to think about my portfolio, the more I can think about everything else. And that's really why I sold the individual stocks. It wasn't because I suddenly became convinced that ETFs are magical. It wasn't because I think stock picking is impossible. And it wasn't because I stopped caring about making money. I actually care more about building wealth than I ever have. I just finally realized I don't need to make investing complicated to accomplish that. I've got roughly $120,000 in my TFSA now. I'm continuing to invest every month, and I'm letting the portfolio compound while I focus on actually increasing my income and living my life. Maybe I'll miss the occasional stock that goes up 500%. I'm sure I will, but I'd rather own the whole market and miss one winner than spend the next 10 years trying to figure out which winner I'm going to miss. Because when I really think about it, that's what I was trying to accomplish this entire time. I wasn't trying to become a better stock picker. I was trying to buy my freedom. And if the point of investing is eventually having more time, then maybe the best portfolio isn't the one that makes you the most money on paper. Maybe it's the one you can keep contributing to, keep holding, and forget about long enough for it to actually work. That's what I'm doing now.